anytime, anywhere, on any device for free. Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
The opening bell has rung. We're at 44,178 on the S&P 500, gaining about 7 points. That was the Dow Jones Industrial Average, which now has turned negative. Now the Dow is just pretty much flat. The S&P is gaining 7 points at 6,336 this morning. We see materials, consumer discretionary. Those are some of the areas where we're seeing a bit of strength. I would say the story stocks definitely would be Caterpillar, which has been to the downside on its earnings, and Palantir higher, which started off about 7% up in the early going. We'll take a look at that as well. Kevin Green is with me, watching all these levels as well. Some of your thoughts. Good morning, Kevin.
Good morning, Nicole. We are seeing a little bit over 60% of the stocks in the S&P 500 in the green right now, and this is actually going to be a pivotal opening when it comes to the S&P 500 just in general. If you're kind of looking at the E-mini S&P 500 futures, the support for overnight was pretty much sitting at 63.58, so we're testing that right now. What you really do not want to see is a break below that level, because the next major area of support for the E-mini S&P 500 futures is going to be 63.20, so that's just something that's kind of on the radar. And as you kind of talked about the sectors, it's kind of mixed when you're looking at performance. You have materials outperforming as well as financials, but we do have a couple of laggards, maybe some concerns around the overall tariff policy kind of moving forward when it comes to semiconductors here. But if I'm looking at it on an intraday basis, 63.80 to the upside can be a key area of resistance here for the S&P 500, kind of testing what we saw back on Thursday of last week around those levels, which was an area of resistance here. And then you would like to see a bounce off of the 63.30. That's going to be your first intermediate area of support. Any type of flush to the downside here, you're looking at 6,300 as that buy area. So we had a phenomenal day yesterday. You'd like to see a nice little follow-through day, maybe not as aggressive as a 1% day yesterday for the S&P 500, but you would not like to see any type of reversal or trying to retest that 6,300 level for the S&P 500. I think there's just a little bit more uncertainty when it comes to the tariffs that are going to be levied here potentially by the end of the week, as you were just talking about with Michelle Gibley, and then also this threat of semiconductor tariffs that could be hitting the wire over the next 2 weeks kind of cause a little bit of concern here for the semiconductor space as a whole. And then we have Friday, the Russia-Ukraine deadline that President Trump kind of implemented as well, or is signaling that could also be a little bit of a headwind. So overall, we still look pretty decent, nice little bounce as long as we can hold the 20-day moving average. We can continue to see broad participation in the market here, Nicole. It seems like we're trying to still retrace some of these losses that we saw from late last week.
Look, I mean, when we talk about the semis and all these chip stocks, I mean, President Trump talked more about he'll be announcing more on this group, so we'll be keeping an eye on that. Texas Instruments, for example, weighed on the group overall. I did mention NVIDIA earlier, which has continued to soar to new highs. Final thoughts on semis?
Yeah, you know, if we actually bring up this 3-year weekly chart, what's going to be interesting with semis is actually going to be AMD, and I believe that we will get a report from them this week, if not today, if I'm not mistaken, potentially after the close. I'll have to check the calendar here, but that could actually be a major driver if they are able to exceed the street's expectations. Obviously, the price of AMD has risen aggressively over the last couple of weeks, and you'd like to see some follow-through when it comes to the fundamentals. But when we're looking at the weekly chart, we did see an area of resistance on the semiconductor index, or the Philly Semiconductor Index, sitting at around 57.30. 54.30, and now it's flagging out here to the downside, hitting a critical area of support at around that 54.31 level. Last week, we actually did test that as an area of support. You'd like to see, once again, some follow through, getting above that yellow band that I have on that chart and really trying to break out. Any type of breakdown below that 54.30, you get a little bit concerned that we might be starting to trade within a range once again, pretty much like we saw around this time last year. Back in September, we started seeing a little bit of a consolidation, not only for the broader equity market, but for semiconductors as a whole. So I think some of the names that are going to be reporting this week are definitely going to be a driver, especially for those speculative high beta names within the tech space here. So a decent little setup. It's still bullish, flagging out like we'd like to see from a technical standpoint, but you'd like to see some follow through and not really stalling out at these levels here if you're a bull in the semiconductor space.
All right, then we look also, thank you for all of that, making notes here, Kevin, as you speak always. Let's talk about what's going on with utilities. This group has been incredible, has been hitting new highs, and certainly a best performing group. Your thoughts?
Yeah, I would agree. Hitting new all-time highs here. And Nicole, if you actually kind of look at the composition of a lot of these utility indexes, if you're leveraging the XLU, that's the ETF, or if you're just looking at the S&P 500 Utilities Index itself, CEG, or Constellation Energy, has really kind of propelled itself to being the second highest weighted within that index, which is very interesting because it's more of a higher beta name. You have the nuclear exposure and things of that nature. VST also seeing some really strong gains here. So you are seeing some outperformance, some relative outperformance from utilities compared to technology, and that's what we have in that orange chart. If you see that line going out, that means that technology is actually outperforming utilities. If that line is moving to the downside, it means that utilities are outperforming tech. So utilities hitting new all-time highs is obviously something that might be prepping for a rate cut here. If we're in that rate cut regime starting in September and it gets a little bit more aggressive, it does make higher yielding asset classes and sectors a little bit more attractive for investors. And then you also have that secular theme as well. What you really don't want to see is a continued outperformance from utilities over the next 2 weeks, 3 weeks or so, because that could also maybe foretell a breakdown in the broader equity market. You could see that back in December of last year, where we started seeing utilities really outperform. We stalled out when it came to the broader index for the S&P 500, and then you saw a breakdown. We're not there yet, Nicole, but this is one thing to kind of keep on the radar here. We've had really great performance so far for the broader equity market as a whole, but you really want to see these factor type of trades kind of still holding up with technology, communication services, and financials really leading the way, because they are comprise of the majority of the S&P 500 as an index as a whole here. So really great outperformance from utilities. You'd like to see new all-time highs for sectors, but you don't want to see it last for too long here. So this is something we'll probably check back in on in the next week or so to see how this performance is doing.
Okay, great to see you, Kevin Green. Thank you for a look there at the markets levels and what we should keep our eyes on. Now it's time to take a look at some more market movers here on Wall Street, and we're looking at HIMS and HERS down 12%. We bring in Schwab Network's Marley Caden to take a look at HIMS.
Good morning, Nicole. Yeah, like you said, HIMS and HERS down a little bit more than 12% after they posted their earnings after the bell yesterday. They missed expectations on both the top and bottom lines, but they were an improvement from the year ago period. Their revenue came in at $544.83 million. That missed estimates for $553, but it was up 73% from the prior year's quarter. EPS came in at 17 cents, just a 1 cent miss. They were expecting 18%. But it is important to note that that was a huge uptick of 183% from the year ago quarter. They said that they now have 2.4 million subscribers, which is up 31% from the year ago period. And their monthly average online revenue per subscriber, which is a very important metric for HIMS, rose to $74 per subscriber. That was up from $57. They also put out a guidance for the third quarter of revenue between $570 and $590 million. That was mostly in line. The street was expecting $583 million for that. And they maintained their previous guidance for the full year of sales of $2.3 to $2.4 billion. Expectations were right for that midpoint of $2.35. Now, all of this, of course, comes after it saw its partnership with Novo Nordisk expire at the end of June in a headline-making event where Novo Nordisk accused the company of illegally selling cheaper copycats of its Wegovy drug and engaging in deceptive marketing. That's what Novo Nordisk said. But right after that happened, Hims came out with a very aggressive international growth plan announcing they were going to be moving into Canada. That move was timed with the new availability of generic weight loss drugs, and they'll also be expanding into Germany, France, and Ireland, growing its footprint in the UK. But with those misses, down 12% right now, Nicole.
All right. Yeah, look, Hims & Hers has had such a tough go of it. First, they had deal making, then that fell through. They were concerned about using composite materials to make the weight loss drugs and things like that. It just hasn't had a go of it. I mean, since that high that we saw of nearly $73 earlier this year. And even though it's come up off the lows of, April and May, for example, it's still having a hard time. And the sell-off here today and the revenue miss really tells the story. Are there bright spots for Hims & Hers to move higher? And that's also a question.
Yeah, I'm not sure about the bright spots. I think they're going to need some bigger announcement than international growth, which certainly could be a driver here. But there's such an optics issue right now, being accused of deceptive marketing practices and potentially creating illegal compounds. I think they have to cross that hurdle. But going into earnings, analysts were mostly bullish on Hims & Hers. They were about 68% for the buy side. So, I think looking for that next bright spot may be a bit of a ways out, but we have certainly seen companies with incredible turnaround stories. So absolutely not out of the question here.
All right, next up, Oracle. A big price target hike today.
Yes,
that's
Oracle
got,
they're up about 1.5% right now. Oracle got a price target hike from Bank of America. They raised their price target to $295, a pretty substantial hike, up from $220 at B of A, saying with a neutral rating that they maintained, citing Microsoft and Meta both increasing their CapEx in their earnings. Microsoft, guided their Q1 CapEx to $30 billion plus, which they said was well ahead of the firm's prior estimate. Meta guided for CapEx of $69 billion, which was well above the estimate as well. And the analyst who covers Oracle at B of A said that he views those as demand signals into the large addressable market for AI infrastructure, and developments like that over this next earnings quarter are incredibly positive sentiment for the AI cycle, which of course Oracle is a key beneficiary. So that's the reason behind that one.
Yeah, that's some good news. $295, a nice hike there for Oracle. Good news there. It has an up arrow, 1.5%. And then we turn our attention over to Pfizer. When we talked about bright spots, this has some bright spots. Let's see what people are really focusing on when it comes to the quarterly results of Pfizer.
Pfizer was one where I think the expectations were a bit mixed here, Nicole, but it's up 4% this morning. They had positive earnings, positive guidance here. EPS beat by 36%. It was expected to be 58 cents. It came in at 78 cents. Revenue also was up 10% year over year and beat estimates by about $1 billion, came in at $14.7 billion. They also raised their full year earnings guidance, and we've seen through this earnings quarter how important that is, that guidance component to your report. That is a lot of what was sending the shares up. And they are now expecting full-year adjusted profit to come in between $2.90 and $3.10. That was above the previous guidance for $2.80 to $3, so they did shift 10 cents in the positive direction. They also maintain their 2025 revenue forecast for $61 to $64 billion. Now, they did add that the outlook includes a one-time charge of what will be about 20 cents per share related to their licensing deal for this Chinese drug maker's cancer drug that they've licensed. Now, this is supposed to be, as Pfizer executives say, a potential game changer for Pfizer. It's a cancer treatment drug that they're licensing, and that charge will be recorded in the third quarter. So that'll be a 20-cent charge. But surprisingly, the COVID drugs were a big part of the story here, Nicole. Increased sales for the COVID products, their vaccine, revenue was up to $381 million. That's a 96% year-over-year uptick, and it was expected to come in at about $205 million in sales. So huge numbers there. Also, the antiviral Paxlovid, which people take after they've tested positive for COVID, posted sales of $427 million, which was also very unexpected. They were looking for that to be about $259 million, so a huge uptick there, almost a $200 million swing, and up 70% from the year-ago period. So they saw a very substantial boost from those COVID drugs for this quarter.
All right. Well, thank you for all of that, Marley Caden, and good luck there at a few key names here on Wall Street. Coming up next, we'll go inside out on Caterpillar, which right now is up 0.75%. Morning Trade Live. We'll be right back.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Morning Trade Live. Welcome back, folks. We're taking a look at Caterpillar after the quarterly results, and very interesting market action on Caterpillar. In fact, we're seeing an up arrow right now, so we want to get more details there. Jonathan Secretas with us, VP of Equity Research at CFRA Research. Tell me a little bit about the Caterpillar story. Good morning to you.
Good morning. Thanks for having me. So this was a mixed quarter. You're really seeing a bit of that play out in markets right now. Pre-market was trading down to about 4 to 5%. Now it's a little bit up on the open. A bit stronger sales than expected. I think that's a bit of the optimism here. If you were to argue for upside, they raised their guidance on sales for the year just slightly from flat to positive. But I think really the main takeaway, what we saw this quarter is margin deterioration. You had a miss on EPS. Currently Caterpillar is dealing with some pricing headwinds, and they're not able to defend their margins currently. So some significant margin deterioration this quarter. Pricing is one of the main levers that these industrial firms have to combat tariffs, and that's a challenge right now.
So right now you're maintaining your hold rating. I believe it's at 437. What's your price target, and why do you maintain the hold? What will make the difference for you?
So currently our price target is 350, though we are reviewing that based on earnings transcripts. But we are reaffirming our hold rating. I think this is a mixed story, partly that it's really a cyclical name, a macro story. This could go both ways depending on whether or not we get interest rate cuts, which would lend to recovery in construction markets. If we get additional trade deals. Right now, tariff uncertainty is causing a lot of delays in purchases of large capital equipment, such as construction machinery and mining machinery. So if this is a cyclical name, really the macro backdrop is what to pay attention to and whether we can expect a recovery. Really, we're looking to see a trough here in 2025 with recovery in sales and earnings next year, particularly in construction and mining. But any indication that recovery could be extended would definitely be a downside for the name. Now, one bright spot to latch on here was power generation markets. So specifically, they're generators for data centers. That AI-driven data center infrastructure investments are creating huge demand across industrial names that have ties to this end market, including Caterpillar. Really, the reason we saw that update to the sales guidance for the full year to slightly positive was because of power generation, up 28% year-over-year, in direct contrast to construction and resources, which was down broadly.
So when I think about Caterpillar here, I mean, you cannot deny this incredible move. I mean, maybe it was too much too fast in your opinion, and I know you're reviewing your price target right now of $350. This went from $267 up to $441. And at the same time, you talked about power generation. That was a bright spot. Farmer sentiment came in, and while it was still weak, farmer sentiment did say that the U.S. policy was going in the right direction. Is that the kind of thing that could also help Caterpillar?
I would say trade policy overall could be of a benefit, especially if certain competitors have a little bit less of a market in the United States. But I'd say the main driver here of the outperformance has been the association between Caterpillar and the AI play, right? The AI trade has gotten a lot of investor interest for good reason, and this backup power generation business for Caterpillar has caught a bit of that momentum, undoubtedly. But we think for investors, it's important also to pay attention to the rest of their business, right? Their construction and mining machinery. Now, even if customers are in a financially good place, looking forward, we're not going to see a whole lot of return to business spending until we get more trade deals and visibility on interest rates. So really, what we're looking ahead for Caterpillar, we're paying close attention to the macro data and where that's pointing towards recovery for Caterpillar's other businesses outside of power generation.
Understood. I mean, when you think about Deere, are you in the same camp with a hold rating or CFRA? I don't know if you cover Deere.
We cover Deere. Currently, we have a sell rating on Deere, but we are looking for indications that we've seen a trough within agricultural markets, right? We've seen an oversupply of a number of grains over the past year, and farmer sentiment has been quite negative, but we're looking for a turn there and to see if an upgrade is in store for Deere.
Understood. Okay. It's great to see you. Jonathan Secreto of CFRA. Really nice to chat with you. Thank you so very much. Good look there at Caterpillar, which has already crossed the unchanged line today. Tom White is with us, host of Fast Market. And you're going to do some example trades for us here for both Caterpillar and Deere. Let's start with Caterpillar, which right now has turned back into the negative. I mean, certainly going over that unchanged line, giving us something to talk about today.
Yeah, it wasn't a great report. They did, on their conference call, come out and state that once they get through the tariffs and once they figure that out, that profits will to continue to move to the upside. So maybe that's why you saw the stock bounce into positive territory, because it was down over 4% when they released their earnings. So I mean, you can see here from the chart, I mean, it's been a parabolic move from those April lows, overbought levels going into this report, just below all-time highs. So I looked at a strategy, really short term. If you think this thing is going to kind of stall out, which it looks like it is, it's selling a call vertical in this name, going out to the August 15th monthly cycle. So just 10 days to expiration. And this is one of those strategies you can do repeatedly if you think it's going to remain below a specific price point. But I looked at selling the 450 strike call and then buying the 460 strike call. So a short $10 wide neutral to bearish call vertical. You're going to collect roughly, I've got 230 credit on it, probably trading closer to $2 now, maybe a little bit lower because the stock has moved back down But the credit that you collect is what you can make on this trade, but it gives you that big cushion to the upside before you start getting hurt on this one and start digging into losses. If you collect a 230 credit, takes your break even up to 450, 230 over the next week and a half. That's about 4% above the current share price in Caterpillar. So even if you're wrong on a trade like this, the stock does move higher. That break even's far above the all-time high that the stock hit just a couple of weeks ago. So this might be the way to look at it where, hey, I don't want to be aggressive shorting this stock, but I do want to, maybe take that position where it's going to kind of stall out. Maybe it's going to pull back. Maybe it consolidates right here. But you can be profitable anything under 452.
Okay. And next week we will hear from Deere. Yep. Jonathan just said they have a sell rating. They have a hold on Caterpillar, which they reiterated today. And they're looking at the price target of 350. But for Deere, in fact, they had a sell rating. Let's hear what your example trade is here.
Yeah, same kind of setup here for Deere. Just a few percent off of its all-time highs that it hit recently. It's up about 20% this year. And maybe a little less parabolic than the Caterpillar chart, but it didn't get hit as hard during those April lows in this stock as far as compared to Caterpillar at this point. So I looked at a strategy that takes advantage of that higher implied volatility in the near-term options. You mentioned they report earnings on the 14th. So I looked at a bearish, to kind of set up with your guest outlook here. I looked at a bearish put diagonal to the downside that takes advantage of volatility dispersion between option series. So going out to the August 22nd weekly options that expire in just about 2 weeks. On this one, we're going to buy the at-the-money 510 strike put. Then against it, we're going to sell in the near term August 15th monthly options that expire in 10 days. We'll sell the 485 strike put. So a bearish $25 wide put diagonal to the downside. You're paying roughly, I've got a $9.50 debit for it, probably trading closer to $10. But the debit you pay is going to be your risk on it. It's a $25 wide bearish put diagonal that you're only paying $10 for, or roughly about $10 for. So it's less than half the width of that put diagonal. And that's because of those volatility levels I mentioned, where you're buying in the August 22nd weekly options, you're buying about a 39% implied volatility, selling about a 46% IV in the near-term August 15th options. As you get closer to expiration over the next 10 days, that near-term option volatility will contract very swiftly, and it's positive time decay also. So this is a bearish setup. Anything below about 505 is going to be potential profitability on this one. But yeah, if you're looking for this thing to go down, take advantage of those implied volatility levels. That gives you a lower price entry point and lower risk on a trade like this to the downside.
All right. Tom White, thank you so much. A good look there at both Caterpillar and Deere example trades for us every single day here, Tom. Thank you very much. Coming up next, it's the morning trade, and we'll preview AMD. The earnings are due out after the closing bell. Today, the stock recently hit a high. Right now, it's trading up about 0.25% at 177. We'll have a preview for you. Morning Trade Live right here on Schwab Network. We'll be right back.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide. no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Spotlight the biggest market trends on Trading 360, 11 a.m. Eastern, only on Schwab Network.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Good Tuesday morning. Welcome back to Morning Trade Live. I'm Nicole Petalides. We're live on the floor of the New York Stock Exchange on the corner of Wall and Broad. Lots of news to digest this morning. Right now, we're seeing a mixed bag for stocks, and now we've seen it turn negative. We've had some back and forth action for the major averages, and we have now, in fact, seen some pressure on the markets overall. The Dow Jones Industrial Average with a down arrow, down about 47 points, and the S&P right around the unchanged line, squeezing out a gain of just 1 point. When you look at the average, you look at healthcare, energy, financials, that's what's weighing. And on the plus side, consumer discretionary and materials. Palantir has been a clear winner, and Caterpillar has gone back and forth. Alex Coffey, co-host of Next Gen Investing, is with us, and you are also taking a look at some of the breaking news concerning the economic data that's coming in as well. What do you have your eye on? Good morning, Alex.
Yeah, good morning, Nicole. ISM services just dropped to the top of the hour, and while the numbers aren't overly alarming, I will preface, misses in all the wrong places, I would say. Headline comes in at 50.1. That is down from the prior 50.8. It is also worse than the expected 51.5. Prices paid, 69.9 is higher than the 67.5 last time, and it is much higher than the 66.5 that was expected. So in both cases, we were expecting the headline to improve from last time. It doesn't. And in the case of prices paid, we expected them to moderate from last time. They don't. They heat up a little bit. New orders also slide from 51.3 to 50.3 in July. And employment also buckles here a little bit, 47.2 to 46.4. So I'm not surprised to see the market turn lower on this. Quite frankly, I'm surprised that we haven't seen a little bit heavier of selling. As I said, I mean, it's not that the numbers are overly alarming necessarily. It's just they're misses in all the wrong directions here across the board.
Yeah, I mean, employment down, and you see services here with a miss. It just shows people are spending less, doing less, and such, right? I mean, that's the takeaway here.
Yeah, and I think the thing, too, about these PMI numbers is that we're essentially, seeing survey results from business purchasing managers about how they assess the situation for their business. So sometimes these are seen as a little bit more forward-looking than, let's say, the jobs data or GDP, which is always looking backwards. So it's basically painting a picture that, hey, prices might ramp up a little bit. Employment in terms of additional hiring is not happening. If anything, contraction within employment is there. And then all in all, new orders pretty flat and actual activity on the whole pretty flat. So not, again, the worst print we've ever seen, but not really a lot to like spark optimism and push back on the disappointing jobs data from last week.
Yeah, understood. I mean, what's the market action here now? I mean, you said you're not surprised to see the market turn around on this news of this economic data. I mean, we still have the jobs report that came in on Friday, which really leaves a lot of questions about our economy. We had the inflation print, the PCE, which showed some inflation, and the Fed more likely to cut rates in the next meeting. The market action here today, as far as sectors, seems somewhat mixed, though turning a little more red.
Yeah, all in all, so far, it's a relatively quiet start to the day. We'll see if it solidifies and firms up in one direction or the other. Obviously, a name like Palantir is doing its best to buoy, sort of the more growth side of the market at the moment. But right now, it's almost perfectly split in terms of up and down, advanced declines. 243 of the S&P components are advancing on the day. 46 of the NASDAQ 100 are higher on the session. A little bit lower in the Treasury market in response to this. All in all, though, the Treasury market has been rallying pretty steady for the better part of the last week, so it might have a little bit of price to give back today. I'm not making too much of that just yet. Other than that, Mag 7 pretty split. Meta, Tesla, Alphabet, and Apple and Amazon all higher. Nvidia and Microsoft, which have been the winners, are both slightly lower. But really what sticks out to me, Nicole, look how dull the color is of that heat map. Just not a lot of big moves out there just yet.
Yeah, I mean, look, I see this heat map, the Visa and MasterCard really stand out in that red zone. I was also looking at Bitcoin, which is down about 9,000 now from the all-time highs we saw just recently of over 123,000. This certainly is something that folks keep. Most of our guests come on and they say you should have a small portion in here, but it doesn't go in one direction, that's for sure.
Yeah, still a volatile asset. Whether or not it's purely speculative risk at this point is tough to say, but definitely within the relatively recent script for Bitcoin to pull back from highs before making other moves higher if it's going to do that. I don't know that technically anything's changed for Bitcoin. Still seems like a pretty comfortable uptrend, but it's part of the territory. A $5,000, $6,000, $7,000 move is not out of the ordinary for an asset that trades with volatility that's 2-3 times that of the S&P 500.
All right, Alex Coffey, it's great to see you. We appreciate it. Nice to see you, Alex. Thank you. All right, it's time for the morning trade, and we take a look at AMD, which is set to report its earnings after the close today. Sam Vadas is sitting here with me at the desk taking a look at AMD, which right now is down just fractionally. Good morning,
Sam.
Yeah,
pretty much flat, just sort of flip-flopping between these sort of marginal gains and losses this morning as we await this very important report card. And the way I heard this characterized this morning ahead of this earnings is that we want to see whether AMD can prove that it is more than just playing second fiddle to Nvidia as far as the perceived little brother is concerned. But as you can see, the stock has had a pretty good run of late. We're up about 46% or so year to date. It really has been an outperformer in this sector. So let me run you through the numbers as far as what the estimates are on the street today. So for Q2 earnings, we're expecting EPS of 47 cents on revenues of $7.41 billion. If we break it down as far as segment revenue estimates, data centers are expected to rake in $3.31 billion. That would be up 17%. Client $2.53 billion, up 69%. So the expectation are for the company to see rising sales, but profits coming off a bit. Revenue is expected to be up very much on those strong data center sales. Remembering that AMD did warn earlier this year that it would perhaps take a bit of a hit from those chip export controls. However, it does seem that the company has very much been communicating the fact that things might be easing up now. Remember, we got that positive headline out of China that chips will be able to go back there, leading that several analysts to actually raise their price targets, certainly on this stock. Price targets are ranging right now between 111 or so to 210. We're at 177 and change right now, so that is implying a bit of downside, bit of upside for this. The questions that the market very much have as we look ahead to this earnings report now is how is it benefiting this company from the artificial intelligence arms race? That's been the big one for all of these companies. Whether it's enough also to justify this rally, as I mentioned, it's really outperformed more so than Nvidia. So can it prove itself as to whether it, obviously warrants what we're seeing here as far as the price action is concerned? I've seen that one portfolio manager over at Allspring Global Investments is saying that in order for this stock to keep the momentum, it really needs to show that it is positioned well in the AI infrastructure space as well, because this is about the broader ecosystem, and also those analysts do want to see it to continue to outperform the broader market. So they are realizing, in their words, that the pond is big enough than for just one fish. But as far as what we've learned so far from the earnings picture, Nicole, and the season, is that the CapEx commitments are also there. So no doubt that offers a bit of a tailwind for the AMDs of the world as well. I mean, when you talk about the eye-watering numbers that the Microsofts and the Metas are throwing out there.
Yeah, I mean, look, we have these names under the microscope: NVIDIA, Broadcom, Marvell. You're talking about AMD, Taiwan Semi. The tariffs are always sort of in our minds when it comes to these names in the semi sector. But really, AMD has hit records, and the stock went up to $182.50 just recently, new high there. So everybody will be listening. What will Lisa Su say? And that can really keep it, because people are big fans of hers. I mean, there's no doubt for her leadership.
Yeah, I was listening to a Bernstein analyst also this morning who was sort of talking about the real story for AMD right now and what we're likely to hear from Lisa Su. They believe that the real story is a next year story, particularly when you look at the MI 450, which will, as far as the market is concerned, make them a little bit more competitive with the likes of NVIDIA. So they say we have time to keep dreaming for now. But, I mean, what have we learned from the group so far, Nicole? I think that's really the big question. To this Bernstein analyst's point, we are seeing a bit of bifurcation. I mean, you and I have sat here morning after morning talking about some of these other semiconductor companies. I mean, we were talking about onsemi yesterday, and it seems that coming in line with earnings as far as the numbers are concerned is still just not good enough. I mean, we were also talking about NXPI, remember, a couple of weeks ago too. I mean, when you've got the exposure to the infrastructure and the auto sector, that seems to be a little bit of a worry, but it very much is the AI story that is propelling some of these names, particularly when you're still waiting for NVIDIA, obviously, the big one, which we're not going to get for a few weeks.
Exactly. I mean, AMD, such a big story. I think you called it the little sibling or something. And just a clarification, I did pull up a longer chart. The 227 seems to be the highest point in the last 3 years, last March of last year, but certainly has had an incredible run and bounce back like many of these semis since Liberation Day. And we're back to tech. We're back to liking tech overall and having tech lead the way. The AI arms race being a key part of this story. The CapEx spending is there, and that really gives it the propel that it needs.
Absolutely. It really offers that tailwind. And what the earnings season has very much told us and confirmed now, Nicole, is that the AI narrative, the CapEx story is still there. But the big question, I suppose, for the markets, and this is something that I've been asking a couple of the guests on our shows about, is, when do we get to a point when we start to question, show me proof of all that spend? And, a lot of the analysts have been sort of suggesting that it's hard to tell because, you have to show that the commitment is there. I mean, everybody is trying to get ahead as far as the AI arms race is concerned, but there will be winners and losers. But I don't think we're quite at a point yet when, those questions are coming to the fore. I think, Wall Street and many traders, investors are being credited with being patient right now with some of the big companies throwing out big numbers at the moment.
It's all about monetization of AI. Great to have the AI arms race, the spending that we're seeing. We see the data centers, we see utilities, but the monetization of AI, and I always keep hearing that it's NVIDIA, Microsoft, Meta, according to the guests. Those are the ones seem to get the story right at this moment. Apple playing catch up. A lot to discuss, but a nice preview there of AMD. So we will wait to hear more on that, Sam Bottis. Thank you. And now it is time for a trade with Tim Bigham, option strategist at Buy Alert. Tell me your trade here. How would you go about looking at this name?
Yeah, absolutely, Nicole. And as you were talking about, little brother has been beating big brother NVIDIA in a big way, at least so far this year, outpacing NVIDIA's very nice gain by well over 10% here. I think the stock will absolutely have to prove it on earnings here. They have to be a big beat to kind of justify this kind of red hot rally we've seen here. So I'm just cautiously looking for a pullback of some sorts, not a big one in any way, shape, or form. AMD, believe it or not, has been above the 20-day moving average every day since last earnings report, which is one of the longest stretches in history. So I'm just looking for the stock to kind of act how Microsoft and some of the other big names did, where it's a sell the news sort of scenario here and a slight pullback towards that 20-day moving average, towards the market maker implied downside move of around 7%. Is what the options are saying. So I'm just going out buying next week's slightly out of the money 160 put, selling this week's 160 put, paying about 75 cents for that, capturing a very nice term structure vol edge here, selling over 100 IV this week, hedging with under a 70. So, define risk all the way, and really just looking for the stock to maybe give back some of the gains we've seen over the past quarter or so, and maybe at some point come back towards that 20-day moving average. So be interesting to see how AMD reacts to earnings, and then ultimately how NVIDIA, which I think may be the last, big name, obviously, to report, reacts as well.
Right. And look, I was talking about so many of the other names in the group. NVIDIA, obviously, always in focus, the leader of the group, the clear winner, and Jensen Huang's the visionary there. But Lisa Su, certainly a lot to be respected when it comes to AMD. But so many of these other names that have gotten moved around, I would say, some in good ways, some in bad ways when it comes to tariffs. And that has been the wild card of the market overall, though the market is really now trying to shake off the tariff talk and move forward and look more at the AI revolution, look more at the, reignition of manufacturing and things like that. Is that right?
Yeah, absolutely. To quote Alfred E. Newman, for those old enough to remember, what me worry, right, about the tariffs, which not too long ago were the biggest concern in early April. Now they're somewhat forgotten about. They will have an effect, certainly not the big effect that everyone was freaking out about not too long ago, but they will provide a drag here. Certainly AI is going to continue to build out, but as you were talking about, just how do you monetize this going forward is the real trillion-dollar question, let's call it. Be interesting to see, but AMD valuations now getting stretched like every other stock out there. People are kind of poo-pooing valuations and everything, getting a little blinded by the AI mantra. I think at some point that will come home to roost, and it probably will be after earnings for most of the companies, similar to what we saw in Microsoft, right, where the stock opened up big but ended up pulling back sharply. Same thing I expect out of AMD and all these AI-related names.
Sure. As I look here at the S&P 500 now, we were talking about the resistance levels of 6380. We even have many pros on Wall Street with price targets higher than where we are now, some of which are at 6,600 by the year end. We've seen the S&P 500, let's say, up about 7%. The Mag 7 group up 27%. So 20 points higher. If you weren't part of the tech play and the AI revolution or boom or whatever you want to call it, you missed it. Do you think these 6,600 level targets seem to be doable between now and the end of the year?
Part of me says yes, part of me says no. My old kind of trader mentality says absolutely not. We're looking at the S&P trading at still well over 3 times price to sales, by far the highest level ever, right? So valuations absolutely through the roof here. But we're seeing just continued, kind of grind higher. We finally traded below the 20-day moving average for 1 day on the S&P 500. We're back above it. So be interesting to see here. Is it doable? Yeah. Is it feasible to stay there once we get there? That's really the question I think that's important.
Okay. Look, right now we're at 63.18. Our own Kevin Green talked about the resistance at 63.80. But if you get that Fed rate cut that folks are now counting on, that would be a big deal here if we were to get that in September. And there's more of a likelihood that we'll get that cut now after that jobs report where we saw the revision of the 2 months, 258,000 fewer jobs in the last couple of months. So obviously tepid, as the president described it. We'll leave it there. Tim Bigham of Buy Alerts, thank you so much. It's great to see you. And coming up next, we'll talk trade and the impact of tariffs on the U.S. economy. We have so much more here on Morning Trade Live, so keep it right here. The Dow right now is down 118 points. We'll be right back.
Trading at Schwab is now powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
No politics, no noise, from bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
with the Schwab Network. Available anytime, anywhere, on any device for free. Schwab Network.
Welcome back to Morning Trade Live. We focus on the recent data that has been coming in pertaining to the economy and really what it says about which direction we're headed. Is it a healthy economy? Are we preparing for a stall? Ali Melli's with me, founder, chief investment officer, and managing partner of Monetiel Capital Partners. Thank you so much for being with us. We have different pieces that come in. Maybe we'll start with the trade balance data. Your thoughts on some of these things like that piece of information?
Good morning, Nicole, and thank you so much for having me. The trade balance data actually came on stronger than expected. On the headline, it shows that both imports and exports are declining, but the sharp decline in the imports, in our view, will be a positive contributor to GDP. Because at the end of the day, it's not gross domestic consumption, it's gross domestic production. And as more of essentially exports are going to be replaced by domestic production, that will be a boost to the GDP.
Yeah, it's very interesting because obviously that trade balance data was really skewed at one point. There was a lot of front loading pertaining to tariffs, right? And we saw imports up heavily at one point, right?
Yes, imports went up heavily. We are on our way to be a steady state. There was some front loading of imports that started skewing numbers ahead of the Liberation Day tariffs, and now we are seeing some of the reversal of that. But the fact that the trend, essentially June is an interesting month because in anticipation of the August tariffs, you would have expected to start seeing some signs of loading up in the imports in both June and July, especially after some of the announcement that the import rates are going to be up above the 10%. So you would have expected to see some boost in the imports. But the fact that that boost didn't happen might mean that we are actually on our way to a new normal. And the new normal might be that some of the imports are going to be replaced by domestic production, and some of the other components that are not replaced are obviously going to be subject to tariffs, which might be helping with the federal deficit. So it is not necessarily clear which direction we are going. There could be multiple impacts from tariffs. Some of it will be replaced, and some of the components that won't be replaced by domestic production is going to be contributing to the deficit reduction, right? At least more revenue for the federal government.
Look, we see factory orders. We're looking at ISM, non-manufacturing and services. We've gotten in jobs report. We got in the PCE. Are there a few of these prints that make your case? Which 2 or 3 prints make the trend for you?
In our view, the most significant concerns that we have are just about equity market valuations. And the issue of equity market valuations, as well as credit market valuations as a credit shop, we are focused on that. The one that gives us some concerns are factory orders. Again, the headline number came weaker than expected. We saw a sharp decline in the factory orders yesterday. Overall, the factory orders is showing that we are growing on a year-over-year basis. On a year-over-year basis, it's growing at more than 3%. If you look at the course of a year, because the issue with the monthly numbers is that the especially aircraft category is very volatile. So May was a month of a strong aircraft orders. May came up 8%, and then June showed a decline. But on a year-over-year basis, nominally, we are seeing a north of 3% increase. But when you adjust that for inflation, factory orders is a number that gives us cause for concern as a leading indicator. That being said, what goes into GDPs, again, is factory shipment. When we look at factory shipment, even adjusted for inflation, we are seeing a healthy growth on a month-over-month basis. And it shows that at least in June, factory shipments and contribution of manufacturing to GDP was very healthy.
You did say that the valuations of the equity market are somewhat concerning. While we see price targets that are higher than where we currently are for the end of the year from some of the big banks and such, where do you think the S&P should be?
I would say if you look at historical norms around earnings, essentially the ratio of earnings to valuation, that actually corresponds to probably like market, maybe I think of these as probabilities. And right now one would argue that we are in a 90th percentile. In terms of valuations being so high relative to earnings, we are at a point in time where 90% of the time market goes below that. In terms of where I would say is a fair valuation for equities, given where interest rates are, I wouldn't be surprised if we see a 10 to 15% drop in equities between now and end of the year.
So if you have that kind of pullback, 10 to 15% drop, what do you buy? What kind of stocks or sectors can do well going forward? And maybe on the pullback, you're going to jump in there.
Well, just with the clarification that we are not an equity shop, and equity is a little bit outside of my expertise. I would say if it's driven by valuation and cash flows, I would look at companies that have good free cash flows. One of the concerns that we are seeing, and that's a broader discussion, is the capex that is going into AI. Is the capex that is going into essentially right now, if you look at the top 4 or 5 contributors to S&P, there are 5 companies that are heading towards having more than $400 billion a year of capex, or what they account for as essentially AI capex. The question is that capex or is that opex? Right now they are capitalizing those expenses. They get to not show that as a cost when they report earnings, and they still record the revenues that they get that are driven by AI, but they don't necessarily show all of their AI expenditures as expenses. And that could be creating some accounting distortion in the way the numbers are created. So if we get a scenario where there is a pullback in the market, I would focus more on industrials and sectors of the market where you can see healthy free cash flow, where capex is manageable, and we essentially have visibility into future cash flow and future earnings that are not going to be impacted by depreciation.
Ali Melli, thank you at Monticello Capital Partners. It's great to speak with you. Thank you so much.
Thank you very much for having me. It's a pleasure.
Coming up next, it's the Chart Master, and we'll preview the earnings for Supermicro, Uber, and Disney. That's coming up next. We'll be right back. No politics, no noise. From bell to bell and beyond. Available anytime, anywhere, on any device for free. Schwab Network.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Trading the trending names every day. It's Fast Market. Ready for you, ready to go. I'm Kevin Hinks. Catch me on Fast Market, weekdays at noon on the Schwab Network.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab.
Schwab, a modern approach to wealth management.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Morning Trade Live. It's time for Chart Master, and Jenny Horn will take us through the fundamentals and take a look here at these key names to watch, including Supermicro, Uber, and Disney. We're also taking a look with Kevin Green at the charts. So thank you both for being here. Jenny, let's start with Supermicro. Some of your thoughts.
So Supermicro is interesting because, of course, the server assembler really is expected to report pretty strong sales coupled with what could be expected to be seen as profitability challenges. So right now, the average analyst estimate for adjusted earnings per share is around 45 cents, down from the 63 cents from last year on sales of roughly $6 billion. That would be up about 13% from last year's figures for revenue. But Supermicro has ridden on a lot of the coattails of all things AI and the massive investment boom we're seeing, specifically in these AI-driven data centers. So along with its competitors really at like Dell, Hewlett-Packard Enterprise, Supermicro does take the very expensive parts for AI servers and assembles them. And so for that reason, sales were in a boom last year, growing 110% on the year. So though this is delicate work, the service is being commoditized now, and Supermicro has been forced to compete on price, as evidenced by its gross margin dropping from an already lower end of their range at around 18% by the end of 2022 to under 10% in their third quarter. So analysts are expecting low profitability to also continue this quarter, as again, it's been read pretty widely that we're going to see this be a remaining risk as it does try to fight the pricing wars right now in this very expensive growth period for the company. So we do know that there's other risks that have also been of top mind for shareholders, including having two customers that represent roughly 64% of its accounts through the end of March. It still also has some accounting control weaknesses that do linger from last year, which has caused, delays in its reporting. It's also caused the reinstatements of some preliminary unaudited quarterly results, leading to then shareholder lawsuits. So Supermicro does do business with, two companies that are owned by the brother of CEO Charles Lang, bringing then charges of self-dealing. And it also does have a relatively anemic cash flow level right now, with total free cash flow losses of upwards of $240 million. So all that to be said, the street has still been very much, the bulls in the same are still very much believers, but it is seeing right now that dominance in the data center build that it once commanded start to wane, as everyone's right now competing for a piece of this very lucrative pie.
Yeah, their question, you did such a great job covering this. I see it. They talk about the margins. That's a part of the concern. These are some of the lower profit for the quarter, but post higher revenue. These are some of the things that I'm reading here. They need to show business progression, and it seems that for at least some of the analysts, that the jury's out. They say it's too hard to call until we actually hear the earnings and numbers and details. Let's see what the chart says. Kevin Green, your thoughts on the chart?
Well, Nicole, obviously there's a lot of speculation when it comes to the earnings announcement, but when you're looking at the charts, you gotta say that this stock has been able to kind of recover from some of those issues that they saw late last year, as well as early on this year here. And we are actually getting to a top of a range, sitting at around this $63 level to around $65. Obviously, if you're looking at last year, we had a lot of issues for the company. You saw the stair-step approach to the downside here. We had a consolidation period for about 2 months there, and then we had a breakdown to around $17.25, completely losing the 20-day moving average, completely losing the 200-day moving average. But one thing to note about this stock and why it becomes actually a pretty decent trader if you're a technician here, these wedge patterns are actually really decent for breakouts to the upside for SMCI. It seems like a lot of traders have been looking at those. And when we look at these wedge patterns, just like we saw back in December, basically coming up into this apex of making higher lows, or making lower highs, as well as making maybe higher lows here, having that come to that apex and we see a breakout to the upside. Unfortunately, these breakouts have not really lasted too long over the last year, but we have seen a nice trend to the upside right now, leveraging that 20-day moving average in blue, as well as this trend line that we've seen pretty much since late June or so. If you do see a form of a breakout here, you could see the stock potentially clearing that $70 level and really getting some buyers to really try to step in here, because this is still one of those names that gets targeted by the retail investors pretty aggressively. If we have any further breakdown, or we do have a reversal here, you're looking at around $54 is your first area of support. That's that 20-day moving average. And then you're looking at the volume point of control, this orange line that I have on the volume profile, sitting around $41.81. RSI actually looks pretty good when you're looking at this price action. MACD, you can make the case, maybe trying to hinge a little bit lower here. I would just be very cautious at these levels, because we have seen sellers step in here before, but maybe this is going to be the earnings announcement that really tries to break us out of this pattern, this consolidation that we've seen over the last year. But a really decent recovery from the levels that we were at pretty much this time last year.
Thank you for that. How about we take a look at Uber, which reports tomorrow morning. Year to date, it's up almost 50%. Some of your thoughts, Jenny. What is everybody watching for?
So right now, it's been a really amazing story of really appealing to this mixture of growth as well as value. So it's been a banner year for Uber, as we know. I mean, stock has, like you said, advanced 50%. We've also seen them continue to increase, their overall offerings, as we've seen just over the quarter. Uber Eats rolling out this new AI-powered feature for merchants. They've also been focused on integrating autonomous vehicles from various partners like Waymo, Pony AI, Wavy, and Baidu's Apollo Go unit. So they've definitely been on the forefront of some of the autonomy push in vehicles. And for that reason, we've seen revenue increase from below $30 billion to more than $45 billion in just a matter of 3 years. Average quarterly revenue growth over that period has also been an impressive 25%. And similarly, profits have also soared over that same period. Net income now stands at around $12.8 billion. That was after posting losses of more than $8 billion only 3 years ago. There was a time when Uber, we could not figure out the right recipe for this company to be profitable. And it was the path to profitability that was really looked at for both Uber and Lyft. And they've really, since the pandemic, been an entirely different company with very diversified offerings beyond just ride hailing, like, say, Lyft right now offers. Uber Eats has been a pretty formidable competitor in the overall food delivery space, now also turning to groceries and becoming more of that one-stop shop for delivery. So turning to valuation, the stock also is surprisingly affordable. Shares of Uber actually have a price-to-earnings ratio multiple of only about 15 times. That's about half the S&P 500's PE ratio, which is around 30 times. Also, Lyft does report as well tomorrow morning, but I feel like in the ride-hailing space, we've seen Uber continue to dominate. Well, DoorDash, yes, still dominates overall food delivery. Uber is definitely the dominant of the two as far as ride-hailing, with, more pricing flexibility. It does seem like so far the drivers also are much happier with some of their take rates than we once saw years ago. So the gig economy is challenging, but Uber has proven it is not only here as a consumer-facing company, but also as far as like a pretty major play on autonomous driving right now.
And Uber was also included into the industrial sector spider. So it's really, and that was a couple of years ago, and it really raised eyebrows. But as you talk about, Uber has multiple revenue streams. It's not a one-trick pony just with one thing. And that it's been a bright spot because it does reinvent itself and continue to grow. And the stock has shown that. Granted, it's about 10% off the highs, but still has been an incredible performer. Let's take a look at the chart, please, Kevin.
Yeah, well, Nicole, as you kind of talked about over the last year, it has been a really good performer here, but I get a little bit cautious as to the developments of this technical structure at this point in time, and here's the reason why. If you look last year, we had this, this channel pattern. It was bullish. Obviously, we were respecting both the resistance as well as support level here. We had a breakout to the upside. It was unable to maintain. It came back within that channel, and then we did see a breakdown below that 200-day moving average. We had a little bit of a consolidation, had some buyers really stepping in at around that $60 level. And we've been trying to kind of move higher ever since here, leveraging the 200-day SMA as a key area of support. Even though we may break through it, it seems like we don't break through it for a very very long time. It tries to recover fairly aggressively here. The reason why I get a little bit cautious, we actually have another channel pattern that has been taking place here, and we actually did just break the support level, and that support level is also coinciding with the 20-day moving average, which we actually did test that earlier this morning, and we are fading here a little bit. Now the broader equity market is fading, so we have to be mindful of that, but does this turn into some form of a shooting star type of pattern here, or a reversal pattern to the downside here? That remains to be seen. The one thing that does make it a little bit more of a bright spot is we are still making higher lows, so the primary trend of the upside is still intact, even though you could see a potential readjustment to the downside. And I would actually look at that $82.20 level as your first major area of support. If we kind of break that, then you're looking at the 200-day moving average. MACD, if you look at the second indicator in the bottom there, that's where you get a little bit optimistic. Maybe we have a consolidation here, maybe a smaller breakdown over the next couple of trading sessions, but maybe we also see a bullish cross to the upside where we are able to then break through that $97 level and continue to move to those highs, and you can kind of expand that channel to see where the next resistance level is going to be. Cautiously optimistic. It still looks like a decent chart, but you did see a fundamental breakdown of a pretty consistent channel here, so cautiously optimistic. Hopefully their earnings are actually pretty well, and it's able to reclaim that channel or even break that channel to the upside here.
Okay. Thank you for that. Can't go yet. We have one more, folks, because we're watching Disney very closely. That reports tomorrow morning. I did see some of the Marvel movies may have been anything but fantastic at the box office, but there's so many parts to Disney as well. Jenny, your thoughts?
Yeah, but those Marvel movies aren't cheap. I mean, I did watch a string of them recently, and I can speak to, like, the production quality is amazing. But yeah, hard to be successful in the box office right now when you have such massive budgets as they do. And I mean, we're expecting some improvement for its earnings right now. ZAX is estimating around $1.47 a share on revenue of roughly $23.67 billion. So that represents modest growth of around 2.2 to 2.4% versus the same period a year ago, just based on consensus. They've also been able to beat earnings estimates in the past 4 quarters. The average surprise has been over 16%. In the last reported quarter, the second quarter of 25, Disney reported earnings that well exceeded expectations by about 23%. So now as we look, into what we're expecting for the end of this fiscal year through September of 2026, right now the average revenue forecast is around $100 billion, with other estimates ranging around $101 to $102 billion. And so we are expecting still some degree of growth, but growth has been costly to Disney. I mean, right now it still has some failing segments where we're still seeing, like, for example, its streaming business still losing money, and its various, like, ESPN, Hulu. There's still been workings that are a bit frustrating when you see a company like Netflix that's consistently hit it out of the park. That really hasn't been the same way for Disney. And also there's that massive element of their business being parks and tourism. And so far, I would say tourism has been definitely hugely optimistic this quarter, better than feared from at least most of the major cruise lines and airlines. But you have a company like Marriott today saying they're expecting more softness in travel for the back half of this year. I have to imagine that impacts the company that is exposed to tourism, and expensive tourism at that. As anyone knows, it is not cheap to take your family to any of Walt Disney's various parks.
Well, yeah, that's definitely well said. To all your points, it's not cheap to go anywhere, but definitely the Disney is excursion of any sort is always something people put under the microscope. What do you think about this stock, which did get up to nearly $125, has since pulled back? Take a look at the chart, please, Kevin.
Yeah, Nicole, the primary trends to the upside here, a little bit cautious. This is kind of a little bit of a 50-50 type of chart. Obviously, we saw some issues last year where it was trying to test that 200-day moving average. It consolidated. It broke higher. We had a little bit of a bull flag pattern, meaning a consolidation within a bull trend, and then it just saw a complete breakdown with the broader equity market, but it also had some fundamental issues that it had to deal with on its own here. Now, back in May, we did see this earnings announcement that really did shock the street to the upside. We saw this nice breakout to the upside, a really decent gap between $93 up to around $100, reclaiming that 200-day moving average, and we've been trending up ever since here. Now, you can just make the case that this consolidation or this pullback is another bull flag pattern. Maybe we do see a little bit of a consolidation before breaking higher here, but the reason why I get a little bit cautious is, well, several reasons. There's 2 gaps to the downside that still need to be either tested or filled, potentially, and one is actually a fairly big gap, and usually we don't see those big of gaps not getting tested for a name like Disney over time here. And the other reason that I'm kind of looking at this, the second gap, the smaller gap to the upside, also coincides with that 200-day moving average. And you're looking at that MACD and the RSI. MACD is actually about to make and confirm a bearish cross. The 12 EMA is below the 26 EMA, but it's also about to approach the zero line. If it grows below that zero line, that's the bearish confirmation that you really need. You're looking at support right now at around $111.75. That's the point of control on the volume profile here. The trend has been decent, Nicole, but you're going to have a repeat earnings announcement like we saw last time in order to really probably give more enthusiasm to this name, given the macroeconomic environment that we are in right now. So cautiously optimistic. Maybe it has run a little bit too far, too fast here. Maybe a consolidation, retest some of those gaps is warranted over the next couple of months.
Important charts, important fundamentals. Thank you both, Jenny Horn and Kevin Green there, taking a look at Supermicro, Uber, and also Disney. Coming up, quick break, and our market meetup panel is standing by. We'll talk about all the market action, things that are driving this market going forward. We'll be right back.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh.
Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl?
Schwab, a modern approach to wealth management.
Welcome back to Morning Trade Live. I'm Nicole Petalides. It's time for our market meetup panel to check out this market action that's already seen some back and forth over the unchanged line. Alex Coffey and Dan Grant is with me, Senior Specialist Retail Trading, Charles Schwab. Thank you both for being with us. Dan, what stands out to you here in all the headlines, in the numbers?
Yeah, I listened to the Trump interview this morning on CNBC, and they were basically talking about all the tariffs, and they were talking about Fed Powell. They tried to hit him with everything, and he was kind of soft, kind of backed away a lot of things. So kind of the most important thing is that the market is still recovering, and the fixed income market still recovering from the jobs number kind of shock on Friday, or the revisions on Friday. Not shock, but it was definitely down. The big note today is that we have a 3-year auction today, and the 3-year note is down 20 basis points in the last week, all the way down to 367, which is pretty significant, I thought. It's 140 basis points below where the long bond is right now. So I thought that was fairly significant going into the supply. We got 3s, 5s, and 3s, 10s, and 30 years this week.
Yeah, and look, I mean, with that President Trump interview, which actually was quite long, he did note a few things, such as the India tariffs, which those are likely to go up a substantial amount in the next 24 hours. He noted Scott Bessent in a conversation with our Treasury Secretary that Scott Bessent does not have an interest to lead the Federal Open Market Committee, and so that we won't see him in that Jay Powell role. And so still, I mean, we look to the two Kevins and maybe others to replace Powell when that time comes. Those were just a few of the things that the president noted. What stands out to you here, Alex, in the market?
Yeah, about an hour ago, Nicole, we broke those ISM services numbers. I told you that the misses were all in kind of the pain direction. It wasn't that they were super alarming or large misses, but employment rather missed to the downside, prices paid to the upside, headline to the downside, and new orders to the downside. And I said I was surprised that we didn't see a little bit more weakness. Now, it may have been a little bit of a delayed onset reaction, but we got that weakness now as this has turned into I won't say like a alarmingly red day, but it's certainly solidified as a red day, at least so far now, an hour and a half into the trade.
Look, we have so many names to watch. Rivian, Toast, Snap, AMD, SMCI, names that are continuing to report earnings. More and more piling in. Dan, anything standing out to you or trends or things that you're watching for when it comes to earnings?
Yeah, not so much earnings, but we're out. Obviously the market's very engaged right now with earnings, kind of looking for some signals right now for economic weakness or some sort of indication what is going to be rate policy. We're going to get a quarter basis point cut, but they're trying to price in a whole half basis point cut. Of note yesterday, the market kind of traded a lot higher yesterday, especially in the Dow, and the fixed income really didn't move. It traded up big on Friday and didn't really have any retracement in that. SOFR contract is kind of what I watched, the 3-month Treasury. Okay.
All right. Palantir has been a clear winner. We're waiting on more names to come. We talked about AMD and Uber and Disney and Supermicro. A final thought, Alex Coffey.
Yeah, just wanted to kind of discuss, we had that heat map up on the board, still relatively, dull colors, so no huge moves, but things are starting to solidify a little bit more red. When we talked at, that first half-hour trade about an hour ago, Nicole, I said it was pretty 50-50 advanced declines. You had about 250 of the S&P names higher, about 50 of the NASDAQ 100 names higher. It's now 185, so let's call it somewhere around, 37, 38% of the S&P 500 are higher. And then in the NASDAQ, it's only 30% of the components are higher. So it is becoming more red by the minute. Nothing too alarming yet, but that's usually how these days go. They start relatively split, kind of like a tug of war. And then, one side tends to win, and it all kind of breaks that way. So we'll see if it gets a little bit worse from here. Nothing too concerning yet, but certainly have the conditions for this to become redder as the day goes on.
And look, Bitcoin also, it's a risk off there. That's down 1.9%, about 10,000 off the high of the 123,000. We did hear from Tom Lee, who said he liked Ethereum going forward. That was something that he spoke about. Great to see you both. Dan Grant, Alex Coffey, thank you. And thank you, friends, for joining me here on Morning Trade Live. I'm Nicole Petalides. Markets have, in fact, swung into the red. Right now, the Dow's down about 230 points. So keep it right here on Schwab Network. Trading 360 with Diane King Hall next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you. With unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Morning movers, be the first to find out what's shaping early market action. Tech Check, Options Corner, Futures Focus, Technical Analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Do you like using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Opportunities don't stop when the market day ends. So neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading specialists who understand the ins and outs of 24-hour trading. No matter the hour, you can trade brilliantly with Schwab.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Good morning, everyone. We are about 90 minutes into the trading day on Wall Street. Welcome to Trading 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. The market giveth and the market taketh away. Let's start out with our roadmap. Coming up on today's show, for our 360 spotlight, we'll cover Hims & Hers earnings as the healthcare company moves lower following its latest quarterly report. The disruptor today is Arista Networks. We'll preview the networking company's earnings. Those are due out after the closing bell today. And for our 360 round, we'll highlight Palantir as the software company rallies off the back of another monster quarter. All right, let's widen out, take a look at where markets are at this hour. We've got pressure on the bulls right now after we saw gains yesterday. You had some weakening economic data putting pressure on the markets, along with comments from President Trump in an interview with CNBC. The S&P 500 lower right now by 0.5%. In terms of sectors, the weakest sector, energy, under pressure, down by about 1%. Financials not far behind, matching that price action. Information technology, the other in terms of the weakest of the laggards. Consumer discretionary doing a little bit of something, not enough to move the needle for the bulls. NASDAQ 100 right now under pressure as well, matching the price action that we're seeing in the S&P 500, off by a little bit more than 0.5%. Dow is off by less than 0.5%. Small caps
are lagging as well, but not as much as what we're seeing in terms of blue chips and the S&P 500, Russell 2000 off by just shy of 1/3 of a percent. All right, let's take a look at the price action in some of the other asset classes that we are watching. Yield on the 10-year right now, no movement there. Dollar barely moving, slightly above the flat line, above 98 though, so holding that level. Gold catching a little bit of a bid today as we see some risk off sentiment rather. So you're seeing hedging catch a bid, gold higher by a little bit more than 1/3 of a percent. Crude oil taking a step back again amid that weakness in the economic picture. You're looking at crude oil off by a little bit more than 1.25%. Approaching $65 a barrel. It's becoming a level that we're familiar with, and experts in this arena say expect oil prices to stay around that level. Bitcoin also taking a step back amid that risk off. Wow, Bitcoin's been sliding recently. Each day it looks small, but today we're approaching 113,000, off by 1.75%. For a look at one of the top moving stocks in today's market, I'm joined by Marley Caden, host of Market on Close here on the Schwab Network. All right, Marley, this is one of the blue chips here, Caterpillar. It's under some pressure today. It's put out its earnings. It looks like the shares of Caterpillar digging. I hate to use the pun there, but there you have it. What are you noticing in terms of its latest results?
It's been a little bit of a move for Caterpillar this morning, Diane, and good morning to you. They were up initially, down a little bit, now mostly unchanged, just slightly lower. After second quarter earnings did miss expectations, but the company did strike a positive tone in its guidance for the rest of the year. EPS came in at $4.72. That missed estimates for $4.88. Revenue did beat, came in at $16.69 billion, beat expectations for $16.35 billion, but it did fall 1% year over year. Caterpillar says that was driven by prices, partially offset though by higher sales volumes. They did raise their revenue outlook slightly, though. That's the saving grace here, why we're seeing ourselves just down about 0.25% right now, so mostly unchanged. They were previously guiding for flat sales for 2025. They're now expecting slightly higher sales for 2025, so they will be in the positive, in the green there. They're also saw a 2.6% decrease in operating profit margins. That fell to 17.3%. They cited unfavorable manufacturing costs there, driven in large part by increased tariffs as the primary factor behind that margin contraction. Now, they forecast tariff expenses to be between $1.3 and $1.5 billion for 2025, with $400 to $500 million of that coming in this third current quarter. CEO Joe Creed did address this on the earnings call, saying the company has deployed some what he called initial mitigation to curb the impact of tariffs, adding the company's considering all of its options, but they do want to await what he called more sufficient certainty on tariffs, adding that their unique global supply chain does add some complexity to the situation. But despite the negative impact of those tariffs, another reason I think we're not seeing a big move to the downside here, Diane, is that demand remains high and their backlog continues to grow. The CEO, Joe Creed, said that they saw strong orders across their segments. Demand was resilient, supported by infrastructure spending and growing energy needs. They did see some small revenue drops in construction industries and resource industries, but energy and transportation revenue rose 7% to $7.8 billion, with a 4% gain in segment profit. So that was also a big growth driver and some positive news in the report.
All right, thank you, Marley. As you mentioned, the shares of Caterpillar actually making staging a fight for those who are believers in that stock. And look, to be fair, it's been an outperformer year to date before today's report. That's our Marley Caden, host of Market on Close. Let's get some insights on the news that's shaping markets. And for a look at the economic picture, we want to welcome in Odetta Akushi, Deputy Chief Economist at First American Financial Corporation. Odetta, thank you so much for joining us. Let's talk a little bit about the Fed and expectations there as it relates to the housing market. So the odds are increasing that the Fed will have to cut rates come September, their next meeting. How much does that matter as it relates to the housing market?
Certainly it matters. We know that the 30-year fixed rate mortgage is loosely benchmarked to that 10-year treasury. But what we tend to see is that the expectations for a Fed rate cut are priced in earlier. So you saw even in the aftermath of that jobs report with those downward revisions, we actually saw a decline in that 10-year treasury. And so we expect that 30-year fixed rate mortgage to come down alongside it. So it's really the stronger the expectations are for a Fed rate cut, the more likely that we'll see a rate benefit to the mortgage rate.
Odette, I want to ask you how you would characterize the state of the housing market now. I know you described this year as a rebalancing. What does that mean?
Well, really, we're seeing a housing market that's stuck. Existing home sales have really struggled to go above that 4 million annualized mark. And I think that's that lock-in effect. You know that 81% of homeowners have rates below 6%. So when the prevailing rate is 7%, there's not much of a financial incentive for those homeowners to move. And now, of course, we have a labor market that is in this great stay where we're not seeing a lot of people leaving their jobs. The hiring rate is quite low. And so that's another lock-in effect to the housing market, reducing mobility. But we are seeing a shift to a more buyer-friendly market. Prices are coming down in parts of the country, even in negative territory, especially in southern and western markets. And so that is allowing for a more buyer-friendly market, some improvements in affordability, which should help some buyers get off the sidelines. But without lower rates, it's really not enough to move the needle. And so what we're seeing this for the rest of this year is what's driving home sales are these life happens events. You have to move because you're changing your job, because you're getting married, you need to, get a new house. But it's really not the financial aspect that's incentivizing moving.
Okay, and it could be a cyclical effect to your point about life happens when homeowners start reaching a certain age or certain milestones. You could see a shift in the housing market no matter what happens with rates. But let's talk a little bit about that lock-in effect. How much is that limiting supply?
Well, pretty significantly, the average mortgage rate on outstanding debt is just above 4%. Currently, rates are 6.7%. And so a lot of those existing homeowners just don't feel that they have a reason to move. Now, we do know that a lot of them are also sitting on a lot of equity. And so that could be one factor that helps to offset that rate lock-in effect. They can bring in a higher down payment to their next home. So there are some mitigating factors to the rate lock-in effect, but by and large, we do think it's another factor that will hold back the housing market this year.
Let's talk a little bit about the new home market. That can potentially be a needle mover, but what do you see?
The new home market has been a relative bright spot in the housing market. Builders, especially the bigger builders, are able to offer incentives like mortgage rate buydowns to entice buyers off the sidelines, but they're facing their own set of headwinds right now. Of course, tariffs are a potential to drive up costs for builders that are already facing elevated construction material costs. But of course, the rise in existing home inventory, especially in key builder markets like Texas and Florida, that's competition for builders. So that's yet another headwind for new home sales this year. So I do anticipate the new home market to still be a relative outperformer when compared to the existing home market because builders are not rate locked in, but they're facing their own set of headwinds that I think could hold them back for the second half of the year.
So what is your outlook for rate cuts for the rest of this year and the broader housing market?
I do think that for the rest of the year, it'll be a lot more of the same. We might get a bit of a rate benefit by the end of the year, especially if the Fed follows through on their rate cuts. We might see rates trend more towards 6% than 7%, which would definitely get the market moving a little bit. But I still believe this is a year of rebalancing. It's not going to be a boom. It's not going to be a bust. It's really just going to be trying to get back to normal.
And really quickly, Odette, do you see 2026 as the year of back to normal or new normal potentially?
I think 2026 will be a year where we're continuing to adjust into a new normal with these higher rates, which historically aren't that high, but you're seeing prices adjust to the reality of higher mortgage rates, buyers and sellers adjust to the reality of higher mortgage rates, affordability hopefully continuing to improve, and enticing some of those millennial home buyers off the sidelines because we know they're there and we know they're interested in owning that home.
All right, Odetta, we'll have to leave our conversation there for today. That's Odetta Kushi, Deputy Chief Economist at First American Financial Corporation. Thank you so much for your outlook on the housing market. We've got a lot more to come here on Trading 360. Next up, it's the big three. 3 stocks, 3 charts, and 3 trades. Kevin Green goes through the technicals, and Joe Tigay joins us for the trades. He's got Palantir. That one's a big mover today. Tesla and Alphabet on his list. That's next on Trading 360 here on Schwab Network.
He's Alex Coffey. I'm Jenny Horn. Join us for Next Gen Investing.
1 p.m. Eastern, only on the Schwab Network.
Welcome back to Trading 360. I'm Diane King Hall. Time now for the big three. 3 stocks, 3 charts, and 3 trades. Kevin Green will take us through the charts, and here to take us through the trades is Joe Tigay, Portfolio Manager of the Rational Equity Armor Fund. It's great to be with both of you. Kevin, I talked to you earlier this morning. Joe, let's start out with the names on your list. Palantir, another big day for this company. The stock is rallying almost 8% at the moment. Tell us about your views on this one.
Yeah, it's just a generational company continuing to deliver stellar growth on complex data issues. And in this world of AI, they are the company that people are looking to as to what are the possibilities, what is going to be happening 3-4 years from now. Palantir is the company everyone is excited about. Now, as an owner, it's something that I'm very excited about too, but you just look at this multiple and it has just grown so far, so fast. It makes a ton of sense to look for some covered calls, to look for an area and just say, hey, I want to just collect a little income, because another thing about these covered calls is these premiums are so juicy. Just looking out to next week, Friday, you can look at the 185 calls. They're like $3. That's about another 6-7% up to the upside. It seems really attractive to me to look to say, hey, I can collect some more premiums while I'm holding Palantir. If we race through 185, great. Maybe I'll roll it. Maybe I'll look for another opportunity.
Okay. Kevin, tell me what you notice about this chart. I mean, look, this has been an outperformer year to date, and there are all these questions going into this report about if the valuation was justified. It certainly, at least from this most recent report, it seems that way. But what do you notice about this chart?
I I mean, it's up to the right at the end of the day. So not a lot to actually put on here when it comes to trend lines and things of that nature. If we look at this time last year, it did trade to that 200-day moving average, sitting at around $21.23. But now we're trading at around $176. So this stock continues to move to the upside, leveraging that 20-day moving average as an area of support pretty much throughout. We did see a little bit of a consolidation back in February where we had this cup and handle type of pattern where we made new highs. We came back, we consolidated for about a month and a half or so, retested those highs, failed, came back, hit the 20-day moving average, and then we started making new highs ever since. So the first thing that you want to see right now is obviously we're breaking out to the upside of this channel that's been well defined since May of this year. That's going to now, that upper end of that channel line, that resistance area is now going to turn into an area of support. So you're sitting at around $162 or so. And if we see any further breakdown to the downside, the 20-day moving average is going to be your first key area of support. Another area of support to be mindful of here is going to be the $125 level. There's actually a pretty sizable node when you're looking at the volume profile at that level, so maybe some buyers would step in there if it were to kind of retrace towards those levels. But the stock continues to move higher. What you don't really want to see is a reversal type of pattern, a shooting star type of pattern, or reversal pattern over the next couple of days, or even on a weekly chart that might indicate some exhaustion. When you're looking at the RSI, you're going to see it's in a well-defined range here. That just means that the price action has been, for the most part, very stable, very healthy. You want to continue to see that. And MACD, for the most part, it's in a bullish formation. 12 EMA is above the 26 EMA, above the zero line here. Once again, not a very complicated chart, up and to the right, and you play the trend until the trend breaks. And there's several different levels to break to the downside here before maybe sentiment changes on this name.
Okay, yep, up and to the right. That's certainly what we see, especially when you look at it on a one-year basis, not just a year-to-date. All right, Joe, let's talk about the next one ticker on your list, TSLA. Everybody knows this one is Tesla. I mean, look, it's been an underperformer year-to-date when it comes to both the broader market and the Mag 7. What's your view on this one?
Another long-term view here for Tesla. People are maybe concerned about the big gift of stock bonus, maybe however you want to call it, to Musk. It's something that's happened before in the past, hasn't really slowed down the stock. I'm still looking long-term. I'm looking for robotics. Now, everyone knows Tesla as a car company, and they're, yes, they have like autonomous cars now. They are all throughout Austin. Google, another company we talk about next, another company that has these autonomous cars, which I'm viewing them as robots. Yes, there are cars, but they're essentially robots. And who has the manufacturing for these robots? Well, that is Tesla. So I think that is going to be their mode. If we look out 5-10 years in the future at Tesla, we may see a company who, Amazon, what cars are to Tesla will be what books were to Amazon, where Tesla is a manufacturing of this AI partnered with a robot, which is what we'll be seeing in the future.
Okay, Kevin, when you look at this chart for Tesla, what do you notice?
Yeah, it's not as bad as maybe the headlines have kind of portrayed this name over the last couple of months. Obviously, we saw this nice rally after the election and kind of that Elon Musk, Donald Trump premium being priced into the stock. It got a little bit rich when it came to valuations, trading at around $480 or so. We saw it lingering up there, and then we saw a breakdown in the stock. Along with the broader equity market, it broke below the 200-day moving average, and it consolidated between March and pretty much, let's say, the middle of May. But we did see a decent little breakout, breaking above that 200-day moving average, trying to test that $365 level. Now, since that level, we have been making lower highs. But if we look at that channel line and extend that out, you could actually see a wedge pattern actually taking place or forming right now. And in fact, the stock is technically making higher lows pretty much since the beginning of June here, and we're getting fairly close to the apex, probably another 2 weeks, 3 weeks or so until we get to the apex, and then you would expect either a breakout to the upside or a breakdown. The fact that the stock has not re-rated lower into that channel once again and consolidating, I think is actually a pretty decent sign here. And once we get closer to that apex, we get a breakout, you get some buyers to really step in, and if you can clear that 350 hurdle, which there's a very big volume node at that level here, that's when you start talking about a squeeze to the upside. And then I would be actually focusing on that 380 to around that 435-ish area for an area of resistance here. So it doesn't look too bad. I know the headlines aren't that great, but at the end of the day, you kind of like to see this coiling taking place before a potential breakout to the upside. And maybe it gives us enough time, maybe in the next earnings announcement or so, as Joe was kind of talking about, to get an update on robo-taxis, to get an update on autonomous vehicles. And if we are continuing to have that thread within this narrative, the technicals kind of suggest that we should be preparing over the next month or 2 months here for a potential breakout to the upside.
Okay, all right. Joe, let's talk about the last name on your list. Is another member of the Mag 7. It's started to play some catch up now. I mean, it's up slightly year to date. The latest earnings, it did better than expected. What's your view on this one and where you take it from here?
Yeah, company closing in on $200. We were there earlier in the year. Their revenue is 20% higher now. So it just makes sense that it could be a lot higher. It's a company not getting the benefit of the doubt like a lot of its peers. It's not being given a super high multiple. Very attractive for me. I think their leadership knows what the future brings. They have some of the best teams in the world, and they're working on several different aspects of this future tech. They're leading in quantum computing. So yeah, for me, this is a no-brainer for me. Absolutely love this name. I'm going to look back in 10 years and think just, wow, what a phenomenal company. And yeah, another company doing this robotics, another company doing the driverless cars. I think that is, the marriage of the AI plus, a physical thing, which will be out there in the world. I'm not sure it's going to come next year, but maybe 5 years from now, we will be seeing a different world of robotic cars and other robots doing human-esque tasks.
All right, KG, take us through what you notice about this chart then for Alphabet Google.
Yeah, this is actually a perfect example of, when the street actually doesn't like a stock, like a Mag 7 stock like Google, maybe it's an opportunity. And we are seeing that kind of come to fruition here when it comes to the price action compared to the narrative that we just were talking about 3 months ago. If you're looking at the chart, one thing I wanted to highlight, anytime that it's in a consolidation or a channel pattern, it breaks that channel. Let's say it breaks to the downside here. The stock generally does go back and test that 200-day moving average. You can see that on the left-hand side here. Back around this time last year, it was consolidating, was trying to push higher, trying to break above that 20-day moving average in blue, but it did see a little bit of a failure. And then it consolidated, and then we started seeing the stock rise a little bit more. Back in December, we had this nice little bullish flag pattern, if you will, but we did have a little bit of a breakdown back in January. Breaking a channel, coming back, testing that 200-day moving average. We failed that 200-day moving average, and we failed it pretty significantly, trading down to around $140 or so. But we have been making higher lows and relatively higher highs here, a well-defined channel pretty much for the last 4 months or so. And what you're actually really looking for, if you're a bull in this name, is try to break above that channel on very large volume in order for us to kind of clear that $200, that $205 level and continuing to move higher. What you don't want to do is hit that $200 level on very light volume, because then it maybe doesn't confirm the price action, if you will. And if you have any type of breakdown, 20-day moving average, your first area of support, $188. And then you're looking at the 200-day moving average, which also aligns with the support level on that channel, sitting at around $175 to $178 here. RSI looking pretty good, higher highs, higher lows in a well-defined channel. And MACD may be showing a little bit of exhaustion here, but still in a bullish formation here. This looks like a really decent chart, Diane, and this just, once again, an example, a prime example of sometimes when the stock is being beat up because of a narrative, there are buyers that actually do step in and accumulate, and we saw a well-defined accumulation phase within Google over the last 6 months.
All right, Joe, any final thoughts on Alphabet, Google, Tesla, or Palantir?
Yeah, there's going to be some volatility. There's going to be ups and downs. We're not going to just go straight up like Palantir. In fact, Palantir, obviously a company that is long overdue for a pullback. But that said, this is a very exciting time. It's just a time where we're going to be, the world is going to look very different than it does today in the not so distant future. That doesn't mean it's coming next quarter. It doesn't mean it's even coming a year from now. So that's where it's really exciting. And that's where we're going to see these exuberant moments like we're seeing in Palantir. We're going to see some big corrections along the way too. So it's just something, as a trader, it's very exciting. As someone who's just excited about the potential for all these technologies, it's really fun to watch.
All right, thank you, Joe. That's Joe Teague of the Rational Equity Armor Fund and our very own Kevin Green. Thank you both. Coming up next, we're going to spotlight Hims and Hers after its latest earnings report and what the end of that deal with Novo Nordisk means for the long term. Trading 360 will be back after this break. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern, Morning Movers, only on Schwab Network.
Trading at Schwab is now powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Trading the trending names every day. I'm Tom White, host of Fast Market. Ready for you, ready to go at 12 p.m. Eastern on the Schwab Network.
Welcome back to Trading 360. I'm Diane King Hall, live from the floor of the New York Stock Exchange. Time now to spotlight Hims and Hers latest results. Weakness in the stock price right now. Joining us now for perspective is Michael Cherney, Senior Research Analyst at Leerink Partners. Michael, thank you so much for joining us. Mixed results here. It seems like revenue is the big hit. 544.8 million was the number on revenue. Adjusted EPS coming in at 17 cents. Tell us your views on these latest results. Were you as bothered by how they performed on revenue as it seems like investors are?
I think it's fascinating. This is the first time in Hims' time as a public company where they have missed on revenue estimates. The company still has high-end growth across our coverage universe, but they did come in below our estimates. Some of that's the transition of the GLP-1 related revenue as they moved away from commercial dosages. But maybe more importantly is for the non-GLP-1, non-weight loss revenue, it did decline sequentially. And so there's a very mixed bag in terms of how the actual results shook out relative to revenue, even though their EBITDA performance did come in better than we had expected.
So there's been a big fight, obviously, between Hims and Hers and Novo Nordisk over the GLP-1s, essentially, right? They had this partnership where they were going to be able to offer Wegovy. Then Novo was mad because they were still offering the, the compounded version of the semaglutide. And so, the idea with Hims was their view is they could still offer it. I don't recall the reasons why. But with that being pulled away, the opportunity to also offer the Wegovy, is that, to you, in your view, is that a big loss for Hims and Hers?
The Novo partnership was so short-term in nature that to actually get any benefit for Hims basically didn't come into existence. Hims' whole push and their whole business model has been based on personalization, how they can drive targeted products to their customers. And that's very much true within the weight loss opportunity. With regards to their push going forward for compounded version or personalized version of semaglutide, that is the push to get to people that have some type of adverse events related to taking a traditional commercial version, whether that's through putting in a different type of vitamin, different dosages. That's where Hims is trying to make its difference so that they can offer a product alongside Wegovy for the individuals as they need them. But it is important to note, too, that Hims's entire weight loss portfolio is not just compounded semaglutide. It does also now include a generic version of liraglutide, which is off patent, as well as various different oral solutions, such as generic versions of metformin, all of which have actually performed in terms of growth quite well for Hims since they introduced them.
Okay, so I know that you expected to see a decline when it comes to GLP-1s. So I'm guessing that doesn't bother you. Is it the other categories where you saw more weakness in revenue that is the sticking point for you in terms of your view of this company as a market perform?
When thinking about both the quarter as well as the rest of the year, I would say my questions, my uncertainty, my concerns definitely fall much more along the lines of the non-weight loss business than they do on the weight loss business. This is a company that generated great success through building out personalized solutions around hair loss, erectile dysfunction, some dermatology products, some mental health. That was where the mousetrap really was created. I know there's been some changes in terms of how they've targeted marketing spend as they've introduced and grown their weight loss business, but it feels like it's been done too much at the expense of what we would call the core. And I think as that needs to re-ramp, the question for the company will be how much do they want to focus on a combination of increased marketing dollars versus product innovation to try and get the core re-accelerated, especially given that there is some expectations, both within their guidance as well as our estimates, that the core can re-accelerate from the first half performance to the second half performance within 2025.
You've got a $43 price target on Hims and Hers. What moves the needle in terms of catalyst to shift from that and to come off the sidelines?
I think one of the issues that we've dealt with Hims recently is the fact that the stock does not seem to be trading on fundamentals. There's been a dislocation tied in large part to a lot of the headlines, notably around weight management, as well as what has been a decided interest from the retail investor community. This is the only company I cover that takes questions from the retail investment side, including from a group of Substack members that before they start to take questions from the traditional analyst community. And so trying to get a matching of the fundamentals of the business, the fundamentals of both revenue and profit growth relative to the valuation is what's really holding us back at this point in time. We do think there is a real opportunity here for Hims to have a differentiated, captive way for a certain subset of the market to offer pharmacy in a way that hasn't been done historically. There's certainly scaling that needs to be done. However, we do think that the go, no-go, particularly around the commercial dosages of compounded semaglutide during the shortage, has somewhat muddled the messaging for the overall equity story as a whole.
Okay, well, shares of Hims right now down by more than 6.5%. So they'd started to stage a little bit of a recovery, but now shifting back. And I hear your viewpoint, Michael, that about it not trading on fundamentals. It'll be interesting to see how it performs through the balance of the year. We'll have to leave our conversation there for today. Michael, thank you so much for joining us today. We appreciate it. That's Michael Turney, Senior Research Analyst at Leerink Partners. Coming up next, the Disruptors will preview Arista Networks earnings. Those are due out after the bell. George Tillis will take us through an example trade. Plus, Sam Vanas brings us a look at Yum off the back of its latest quarterly report card. Trading 360, we'll be right back.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Diane King Hall live from the New York Stock Exchange. For a look at stocks on the move, I want to bring in Schwab Network contributor Sam Bonis, taking a look at Yum Brands off the back of its latest quarterly results. All right, Sam, this stock is under pressure right now. Take us through some of your takeaways here.
Yeah, it does very much seem that we are seeing shares under pressure, as you say, off the back of what has been an earnings and revenue miss from Yum Brands, which is, of course, behind the Taco Bell's, KFC, and Pizza Hut. So let me run you through the numbers as far as what we got from this report card. We saw EPS of 144 versus 146, which was expected on revenues of $1.93 billion versus what many analysts have been expecting at $1.94 billion. The bright spot, let's start with Taco Bell, because it's Taco Tuesday after all, and this has really been seen as the jewel of the portfolio. That was really the outperformer as far as same-store sales growing 4%, even though the street was actually looking for a little bit more here, but we'll take it. That's thanks to the crispy chicken products. Chicken sales have been up 50% over the last 2 years, but Pizza Hut and KFC same-store sales actually falling here domestically in the US. The home market for these brands very much seems to be dragging here at the moment. The companies are doing well, though, overseas. Both saw US same-store sales down 5%. KFC overall seeing that growth up 2%. As I said, thanks to the strength in the international markets. We know that China is a big market, particularly for KFC, but it has also dropped down the rankings of chicken chains, I should say, from number 3 to number 5. Now, Pizza Hut also seeing same-store sales down 1%. And in this case, international doesn't seem to have been enough to offset the weakness that we're seeing here domestically. Now, the good news, as far as the earnings report is concerned, is that they do seem to be gaining market share as far as some of the brands here, boasting that while others are reporting negative quarters, we haven't had a negative week. But we do know that there are challenges for some of these restaurant chains as well, contending with a value-hungry consumer right now. Pizza Hut's US sales slipped because of what has been described as insufficient value message, but they are trying to address that with some of these new promotions. But we know also that a number of the headwinds have been around the fact that consumers are just not dining out as much, Diane. You know, I mean, we've heard some concerns over at the Chipotles and the Shake Shacks of the world, although they do seem to be reporting that they are seeing a pickup in traffic, especially in July off the back of promotions. But we're also going to be hearing from McDonald's as well, you know, particularly when it comes to the value-hungry consumer and what they're doing to address that.
Yeah, look, I mean, and to be fair, Yum has actually had a gain year to date, slightly underperforming the S&P 500, but you can't say the same thing, for instance, about Chipotle. So it looks like in terms of how investors saw this, as they saw this still being able to hold up if the consumer had some weakness here. I'm only seeing a little bit of movement in terms of the sell side. Wells Fargo adjusting their price target on Yum, lowering a little bit. But it's interesting to hear about where it stands in China in terms of KFC.
Yeah, look, KFC has always been a popular one over in China. I mean, as far as the American brand is concerned, particularly around fried chicken. As far as some of the commentary out from the company themselves, they have actually been talking about a strong quarter in what has otherwise been a tougher consumer environment. So they very much do acknowledge that. This is obviously David Gibbs' last conference call before he retires. Chris Turner will take over in October 1st. So when you talk about some of the sell-side analyst thoughts here, Diane, obviously no doubt some executive leadership shake-ups and changes are going to be one to track. No doubt investors will be watching to see how that all takes shape, particularly as investors have been watching a lot of these companies as to how they're addressing, no doubt, some of these consumer trends, but how they're also looking to innovate as well.
Right.
But such a fascinating report out. I've also seen a story about how Yum Brands have been really seen, and this is just sort of a side note, but certainly interesting, as an incubator for some of these CEOs, a bit of a sort of training ground for a number of those
Brian Niccol
executives.
came through there.
Brian Niccol among those. He has Yum connections as well. So, has really been seen as having a reputation of a place that is sort of where some of these executives that have gone elsewhere have managed to cut their teeth, for lack of a better term.
Indeed. No, that's a perfect term for this situation.
I'm getting hungry.
I was literally going to say that, and now I'm hungry. I am hungry. But okay, thank you, Sam. That's Sam Vada, Schwab Network contributor with a look across Yum Brands after his latest quarterly report card. Time now for the disruptors. Joining us with today's company is George Sillis, senior markets correspondent. We're taking a look at Arista Networks. We're going to pivot left completely out of food to try and get our mind off of food. All right, so the earnings are due after the closing bell today, George. What's the setup going into this?
Well, I think the setup for AristaNet, Diane, is what the hyperscalers that are purchasing their network gear are doing. And that includes major customers like Microsoft and Meta Platforms. Some suggest that the exposure that AristaNet has to Meta Platforms is close to about 25% of their total sales. And I think what's happening here for AristaNet after recovered post the April lows that the overall market dipped on. There's aspects of capital expenditures which are still very robust, including companies like Google, Microsoft, and Meta Platforms. And we need network gear, and essentially AristaNet, for those who don't know, is a major competitor in the hardware and software-defined services for networks. And we can't have artificial intelligence computations that, of course, are backboned by companies like NVIDIA and AMD without networks which deliver that content to the cloud or to the end user. And that's why these businesses like Cisco and AristaNet have done extremely well over the past few years as part of this secular trend in artificial intelligence and data center deployment technologies. And if you look at the value proposition always has been with AristaNet is that they provide both bundled and unbundled services, and some of their unbundled services include agnostic features where they separate the hardware from software. And that actually is a great value proposition for major customers like Meta Platforms, which may end up using just the hardware side of their components versus the software which they develop on their own. Now, if you look at the aspects of the EPS estimates, they're expecting more than 20% sales and earnings growth at 65 cents in terms of EPS, higher than the 53 cents last year by about 24%. And sales are also expected to be higher by close to 24% at $2.11 billion versus last year's $1.69 billion for the same quarter. Now, the other thing I'll mention here is that sequentially, it looks like this is not a growth quarter from last quarter because the company did post also around 65 cents in EPS. So we'll see if they actually move the needle higher this quarter for the remaining portion of the year.
Yeah, it'd be interesting to see on that front, and then especially if the exposure that it has to Meta ends up being a tailwind, given that it's about a quarter of total sales there. So then when you think about this, and look, it's got a gain year to date, it's got some weakness today going into its results. How do you approach this from an example trade basis, George?
Yeah, so what I'm going to do in this case is we're basically going to play a very narrow time frame with Friday's expiration, and I'm going to play probabilities. And what I'm going to do is also take into account the trend. So I'm going to skew this iron condor or credit combo, as we call it. So we have some flexibility to the upside because that's the direction of the trend. And if you look at the market maker move, which is basically an implied one standard deviation move, post earnings, it's around $10. So I'm going to sell a little bit higher above the $10 market maker move by a fraction, and then sell a put spread below that at the market maker move. So this is basically a trade that has about a 60% probability of success. And so what we're going to do is we're going to sell the 130, 135 call spread above the current price, and then we're going to sell the 107, 102 put spread below the current price. So it's a four-legged structure. You could sell this for about $1.50 a contract, or $150 a share, forgive me, or $150 a contract. So in essence, what we'd like to do is have the stock stay range bound between the short strikes, and that's 130 high, and then of course 107 low. And then of course you have to consider your max profit, which is $1.50. That's as much as you can make, and then your risk is $3.50, and that only occurs if the stock blows out in either direction above 135 high or 102 low. So this is a trade that basically has about a 60% probability of profits, and you're getting essentially a $1.50 return versus $3.50 risk, or 42% return on risk. But you have to be mindful, only 3 days to expiration on this trade. So if it's well contained, that premium will evaporate rather quickly by Friday.
Okay, all right. Thank you for the framework there. That's George Sillis with our example trade and a look at ANET. Those results due after the bell there, the example trade approach in Iron Condor. Thank you, George. Coming up next time for our 360 round, we'll bring in our panel to break down Palantir's monster quarter as the stock rallies today following its latest results. That's next on Trade 360.
Trading at Schwab is now powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me, too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab.
Schwab, a modern approach to wealth management.
Welcome back to Trade 360. Time for our 360 round. For that, I want to bring in our panel to dive into Palantir's latest quarterly results. We've got Ali Mogharabi, Senior Equity Analyst at West End Capital Management, and Dale Smothers, President and CEO of RDS Wealth Management. All right, strong quarter. That might be an understatement. When we're speaking about Palantir, their first quarter where revenue topped $1 billion, adjusted EPS coming in at 16 cents a share, firing on all cylinders, whether we're talking about commercial or government revenue. Commercial up more than 90%, government revenue up more than 50%. Ali, I'll start out with you. What's your take on its latest results?
I think you said it perfectly. I think everything was much, much better than expected. We were certainly impressed with the top line growth, but also at the same time, margin expansion. So, you know, a lot of investors could actually look at this and say, well, valuation multiples are too high. But, you know, this is not just a growing company. This is a company that's widening its margins and increasing the free cash flow that it continues to generate. And obviously, you know, they're actually not necessarily doing cost control, but they don't need to. So as the revenue continues to grow, margin is going to expand. They don't necessarily need too many sales reps out there. It's a word of mouth type of marketing for these guys, which just comes naturally. And it appears it's based on the performance of their products. So in my opinion, everything looks pretty good for this company.
Dale, I'm curious to know your thoughts. I want to share a couple quotes that you may be familiar with from the earnings call with CEO Alex Karp. And what's funny is I've seen him here at the stock exchange in person. It comes across understated in person, but he said on the call, quote, "I've been cautioned to be a little modest about our bombastic numbers." He went on to say there's no authentic way, though, to be anything but have enormous pride and gratefulness about those numbers. He said, quote, "We're very proud and we're sorry that our haters are disappointed, but there are many more quarters to be disappointed, and we're working on that, too." Do you think it's fair to have such strong expectations about Palantir, especially because one of the questions, and I think Ali just alluded to that, has been the valuation is just so stretched. But, when you look at these most recent results, it feels justified now. But what's your take, Dale?
Yeah, Diane, you're exactly right. Ali also alluded to something that is unique about Palantir, and many critics even criticize this to the point of it's going to be their existential threat, that they have no real sales force. It is all word of mouth because of the way they integrate into corporations. And if you listen to the sales call, you hear Alex talk about that specifically. Alex, bombastic, those two words go hand in hand, and I believe that he's running his company with this. A sense of pride is something that he is not bashful about, and he even talks about in his earnings call that just came out, he talked about creating a new level of credential just for working at Palantir. He believes solely that this company is going to change the world, and nothing about their statistics, nothing about their earnings, nothing about this company gives me anything to believe otherwise. I'll tell you this, Diane.
Oh, go ahead. Sorry, Dale. Finish your thought.
No, I'm pro Palantir for sure, and it's all because I think that they truly are building this company based off of what they believe, and they're not bowing down to any other of the naysayers in building this company.
Okay, Ali, I'm curious to know your thoughts on this because there are still some, I won't call it naysayers, but there are those who are cautious. You have analysts who are bullish. Wedbush is boosting their price target. We know Dan Ives is very bullish on Palantir. He calls it the Messi of the space, and they've raised their price target to $200 a share. Morgan Stanley, though, still equal weight on Palantir, but they are raising their price target, but it's below a level where it is right now. So that, to me, signals they see some downside here. Do you think that piece of part of and I'm just using them as an example because there are others on the sell side who have similar thoughts. Who is right from this perspective, from your perspective, rather?
I would say, obviously, Alex Karp has demonstrated that the pessimists are wrong in terms of, how the stock is going to perform going forward. It remains to be seen. We could look at it from a technical standpoint. It actually has created a nice space at around the 150s. And going towards 200. So 200 does not seem unrealistic anymore. It seems more realistic. From a valuation standpoint, as I mentioned before, it's really, again, it just remains to be seen. But let's put it this way. As Alex said on the call, if these guys are going to generate around $10 billion in revenue, annual revenue, in 5 years, and you look at that continuing margin expansion, then you're looking probably at free cash flow growing at 50, maybe 60%. Well, I should say free cash flow margin being around 50, 60%, and the growth also very, very accelerating. I should say very impressive. So you plug that into a regular discounted cash flow model, it does not seem that unrealistic. But as I mentioned before, they've continued to prove pretty much everyone wrong on the street.
Okay, yeah, it does seem to be the case. Dale, I'll give you a final word. We've got about 30 seconds. What do you see as the difference maker when it comes to Palantir?
Yeah, Diane, I think the difference maker is the way that they implement AI. They are creating a new global world operating system. They're not just creating the next Chat GPT, They are truly hoping to change the world with the way that they not only impact lives, but save lives. This is a battlefield technology. This is a healthcare technology. This is a blue-collar technology. And Ali alluded to something there, that the valuation is very high. And in our opinion, this is a hold for now. I'm not saying we're rushing out to buy more of this at this particular valuation. But if you look back and think about Amazon when it was just a bookstore, it was overvalued. Tesla, when it was just an automotive company, it was overvalued. This is a game-changing AI company, and you want to be a part of it.
All right, Dale and Ali, we'll have to leave our conversation there for today. That's Dale Smothers and Ali Mogharabi with perspective on Palantir. Those shares rallying today. Thank you, guys. And thank you for joining us today on Trading 360. I'm Diane King Hall. Download the free Schwab Network app and tune in 24/7 on schwabnetwork.com. You got Fast Market up next.
Schwab Bank Investor Checking, the checking account built for investors. Named highest in client satisfaction by J.D. Power for 7 years in a row. With Investor Checking, you get the award-winning features of our checking account, plus cash management solutions, all designed for investors like you, with unlimited ATM fee rebates for cash withdrawals worldwide, no overdraft fees, and enhanced security features to keep your money safe. Also, because your investor checking account is linked to your Schwab One brokerage account, you can manage your checking and investing in one convenient location. Moving funds between your accounts is easy. Cash moved to your brokerage account is available in seconds. That means you can stop waiting and start investing in stocks, bonds, money market funds, and more. Get more with Schwab Bank Investor Checking, the checking account built for investors.
Hey, Dad, I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
Opportunities don't stop when the market day ends, so neither do we. Schwab gives you round-the-clock access to over 800 of the most popular stocks and ETFs, plus a wide variety of futures markets. All with 24-hour support from trading